Good morning, everybody. Hope everybody's doing great today. I am Mark Sebastian. I am your only option. I am joined by one, Andrew Giovinazzi. He is our resident volatility expert, and we're here to talk what's happening today. And if you were here for the ticker highlight show yesterday, what did we tell you to expect? The market at the time, I believe, was down 200 points yesterday. We closed down 11. And then today we're up another 183. I believe that is a good, almost 400-point rally. And what were we telling you was about to happen? All right. But I don't want you thinking this is a layup now. Let's just go long and buy all the FANG stocks again, because this is a different market. This is a different market. We've repriced a lot. Now, when talking to Alicia, looking at the levels, we're at a very key level today. Right now, as I'm speaking, we're at the highs from yesterday, and we're over 52.50. Those were key levels to see, hey, can we get, is this a, rally in the morning and then they fade? Or is this a true kind of dead cat, a true kind of relief rally where maybe we rally Tuesday and part of Wednesday, and we're kind of right at that level, and volatility is doing a lot today. So I just want to kind of go back in history real briefly, and then we're going to get into what Andrew's doing. Why don't we share my screen, Justin? What we are looking at is July through October of 2011. And again, this is the last time I can really think of the kind of government getting in the way of markets, if you will. And I'm not judging what is being done either way, but what is being done has certainly brought market chaos. I think we can all agree on that. Last time we had the government kind of self-institute market chaos was when we had the debt ceiling crisis in 2011, and Standard & Poor's downgraded our debt. You can see it started to sell off. Then we got a couple of really ugly days. Then we got one big, huge reversal candle, little sell-off, reversal candle. And then after about, a couple of weeks, we started to make up some of it, got to a new low. We didn't hit the new low until October 4th. And then we started a sustainable rally. So there may be some chop here, folks. What I'm saying, I know we all think that every bottom looks like COVID. All right. Everybody thinks the bottom looks like COVID. And the bottom does not look like COVID most of the time. And this is another reason why we bring on our resident volatility expert, because Andrew's trading goes all the way back to before the dot-com bubble. So he may look like he's in his mid-40s, but the man has experience. So to guide us through this, that's why I brought him on today. I wanted to talk to Andrew. Now, Andrew, you are a volatility trader. You focus on all things volatility, but notably, you're very keen on the relationship of VIX and the SPX.
Yeah.
So, I told everybody what I was doing yesterday. Kind of, why don't you talk people through what has happened? You had a really nice win on a VIX call spread yesterday. Why don't you talk to everybody about kind of what's happened and what you're doing in this market right now? And we can stop sharing my screen.
So in 4 years, 4 years from today, it will be 40 years since I walked onto a trading floor on my first day.
Wow.
Which actually is kind of freaking me out a little bit, to be quite honest.
I can imagine.
Well, a little freaky.
But Andrew, we had probably the outside of, let's say, kind of the weird yen crisis, But I would argue that this was the biggest volatility event that we've seen, even including the yen crisis, since COVID.
You mean since 2024?
Since 2020.
Well,
overnight, when markets are really wide, the VIX, the volatility index, which is our best measure of option prices, got into the 60s during the yen carry. But that was all pre-market. That wasn't like we weren't trading when that number hit.
Yeah.
The number from yesterday on the and so on August 5th, let me go to the 1 year. On August 5th, VIX got to, pre-market as high as 65.
Mm-hmm.
Yesterday, we got to a high of 60, but that was during the trading day when there is actual activity and you can really rely on that VIX number. So I would argue that what we're going through is hands down the biggest volatility event since 2020. So given that environment, how are you attacking what we are seeing?
Well, again, two-way trades, the idea of two-way trades, the whole reason I came up with this as a concept is if you're going to hold overnight option positions, how do you deal? So if you guys just look at my screen here for a second.
Why don't you briefly tell everybody what is a two-way trade?
Right. So they come in many guises, many forms, but what, at least in weekly profit cycles or whatever kind of trading you want, most people are looking for I'm just going to buy a call and I want it to go up, which is great. It works. However, if you want to use volatility to your advantage, there are use market pricing to your advantage. There's a lot of things you can do. So there are relationships that work. So the most important one is, did you know that SPY in the last 10 years, I think it's 98% of the time, 96% of the time, will move at least 2% a month. Okay, 96% of the time over the last 10 years. So how do you trade that? How do you take a pattern like that and try to make money? The idea of two-way trades is essentially, if I see something that's moving, I just want to make money if it moves. I don't care if it goes up or down. I just want to try to find a way, right? And I believe I have found a way to make money. It doesn't matter which way it's going. So when you're looking at something like when VIX goes straight up, like it's just done, there's going to be a corresponding contra side or other side. What is the rest of the market doing when VIX is making a power move up? Okay, SPY in general is making a power move down. So setting up trades like this, being ready to do that. So you either, all I need to do then is set up kind of like one's going up, one's going down. I just got to make money on one. And as long as my package makes money, I have an interesting, I have a good trade. I have a trading system. And then you just close your trade. So because the market is doing what it's doing, so let's see what's going on with VIX right now. So here's our, the SPY is up today. Again, right where Mark said, a key level. Now, if you're looking at this, you're saying, Andrew, is this over? Is it all over now? Is this whole tariff thing done? And what
I'm wondering that, Andrew.
Huh?
I'm wondering that. What are you seeing?
Well, what at least is happening on the horizon that we know for sure is going to happen in a day?
There'll be tariffs.
April 9th, right? So, at least in the short term, there is going to be, the hammer is going to come down one way or the other. So now, even last week, what did we just learn, right? We just learned that the market doesn't like them. And it's the response to it is going to be totally unpredictable. Did anybody predict we'd have 3-5% down days in a row? Right? We had Thursday. Friday was actually closer to 6. And then when we opened down Monday, I think we were down, what, another 5% in the morning.
Overnight futures were down almost, overnight futures were down almost 6%. It was that bad.
So again, when you're quantifying this, right, when you're quantifying this, you all of a sudden have.
Why don't you tell everybody what they're looking at right now?
Right. So here's just a one-day move in SPY from 480 to 520. Now, the fact that a news service would post something about the tariffs being postponed 90 days without any fact checking or anything like that, like, that's criminal in my view.
It kind of is
totally irresponsible. Now, but what you want to see is, how does the market react to that? The market is reacting to any piece of news like Crazy Town. And what that means, if I want to define what Crazy Town is, that is VIX trading at 36 or a 40. Because what this is telling you is how much you expect VIX. The VIX is telling you how much we expect SPY to move on average. So if you think about it like this, every 16 points of VIX is 1% per day for SPY. So if we're trading at a 30, 16 and 16 is 32, the market is expecting SPY to move 2% a day, at least every single day for 30 days. So right now, the market is saying this is not over by any stretch of the imagination. So here we go again. We gap up 15, 18 points again. We're almost 20 points up SPY, 3.8%. Here's another thing. Do you think VIX is underrepresenting how much the market is moving, or overrepresenting how much the market is moving? So if I'm saying VIX at a 36 is 2%, and we're up 4% gap, almost a 4% gap here, right? VIX is actually, I believe, still underpriced, right? It is underpricing the day-to-day. Yesterday, down 30 points, almost 30 points, up 40 points. That's a 70-point range. Down 30 points. That's a 100-point range. Up, look at these 20-point moves. Don't even look like these are 20 points move in SPY. 120 points, down 100. Now we're up to a 140-point range. We almost had a 200-point range in SPY yesterday.
Yeah, I mean, the average true range has been absolutely explosive. Yet again, ATR, which is kind of how much we've been moving total up and down every single day. Average true range for the S&P 500 right now is 145 points. That means when you wake up in the morning over the last 10 days and you're like, I wonder what the market is going to do, you should plan on between the bottom and the top, there's going to be at least 150 points.
Right. So
that is monstrous. To put things in perspective, the absolute high in COVID was 146. When we were at peak fear, the absolute high was 146. Now, the S&P was a lower number, so there was more volatility, but I just want to put things in perspective of where we're currently at. And, you know, when we talk about option prices price in movement. And when the VIX, which currently stands at 36.85, that's pricing in, what, 2.5% a day? Less than that, 2.25%.
All right. So right now the thing is, so even though VIX is very high, Mark is pointing out the market's moving a lot more than that. And the idea is just setting up a trade that you can put on, and you can watch it run with some confidence overnight, because you are not totally married to one direction. You just need to let the market move to a degree and then close the part of the trade that's paying. So what I've done is the whole idea of coming up with two-way trades. So I'll kind of share with you what I did Monday with some of my students in class.
So to kind of wrap things up in a just in a box, a two-way trade is you're playing the fact that VIX goes higher when the market drops, or when the market rallies, the VIX goes lower, and you know one side of that trade, when you play VIX versus SPY, is going to pay you. Right. And that's based on the historical movement that we are eclipsing, 2% a month. How about 2% a day? So this is kind of prime. So yeah, I'd love to see kind of what is a trade that you think makes sense in this market. How are you trying to make money right now?
Right. So the idea here was this is, let me make sure that I'm kind of, there we go. So the idea is this. So this is yesterday in class, and what I'm teaching my students is how do you approach, trading volatility, trading the market, but just trading in general with cause and effect. So yesterday, the idea was, I don't think that this volatility event is over by any stretch of the imagination. So I want to buy one VIX call spread, like basically because when the market goes down, volatility goes up. That's going to be what I'll call, this is my short, right? This is my bearish part, right? The bearish part of the trade.
This is the part of the trade that makes money if the market drops.
Correct. So right now, I can buy a call spread in May in VIX, a 30-45 call spread for $2.40. However, VIX is trading 37. Now, you're going to wonder, why is your call spread so inexpensive? I can buy something a 30-45 call spread that's already $7 in the money, and it's only costing me $2.50. So if this volatility continues for another month through May, up, down, whatever, I know this call spread is going to make me, is going to be worth around $6, almost $7. Now, in class, I show you all the, the varieties of, or, kind of how to price these things and why it's an anomaly and why it's edge for a retail trader, right? What's the number one edge for retail trading or retail investing? Your edge as a retail trader is you get to pick your entry and you get to pick your exit, right?
And
liquidity
when he says
providers,
when he says edge, what he means is your advantage.
Yeah,
right?
your
as
advantage.
a market maker, the advantage they have is they get the bid-ask spread. As the trader, as the retail trader, no one's coming into your house and saying, push this button or you're fired. Right? You have the power to decide when to trade and when not. No. And that is, I think, incredibly powerful and maybe a facet that retail traders don't think about. So, Andrew, your side of the market trade that has this edge in it because VIX is trading 37 and you're buying a $30 call, which is $7 in the money, and selling a $45 call against it. That's called a debit spread or a call spread or a bull call spread.
Right.
And you're only paying $2.40. So if nothing happens, if the VIX just sits here at 37,
correct.
And we're not claiming that's going to happen, but we want to make sure this is understandable. So if we get to May and the VIX is 37, you paid $2.40 for a spread that would expire worth $7.
Right.
That's almost a 300% win.
Yep.
All right.
So that's our short market piece. So that basically sits and it works for you, right? It doesn't go to zero tomorrow. It is sitting working for you as a protective unit. Now on the other side, right? Again, two-way trades, meaning you have two ways. You have a bearish part, right? Or a market short part, and then you have a market long part. So here's my bullish part. So yesterday in class, I actually filled these a little better than 325, but you'll get the idea, around 275, I believe. But now I want to buy a call spread. So the whole idea of my trade is I want to be able to hold these for a little while, right? Because if you hold things overnight, you have overnight risk, right? Market up, you're doing great if you own a call spread. But if we gap down, 20 points or 30 points, your call spread all of a sudden down, your 325 is worth $2 or, $1.80. So you need something that is going to pay you if the market moves down. But now what I've done is I've set up a trade where if the market stays volatile, I'm going to hold on to my made position. If things are moving around, right? Like Mark says, if VIX stays up here at 37.38, what does that mean? That means whatever's going on with this tariff stuff is continuing. It's not going away. However, all I need is one day out of 30 where SPY decides to go up. I don't need very much.
And today is your day.
And actually, I sold these this morning for about $4, very close to $4, $3.90,
yeah,
some between $3.90 and $3.95.
Yeah, currently they're worth $4.05.
Yeah.
So Andrew bought for May 2nd the 525 call and sold the 532 call. That's a call spread. And he paid $3.25. Yesterday, it's already worth $4.
Right.
So he's already starting to pay for that VIX call spread. Next thing you know, we get follow through into Wednesday, and the call spread is worth $5 or $5.50. And now Andrew has made, let's say it goes to 550. Andrew sells it at 550. He makes a $2.25 profit.
Right.
How much is that 30-45 call spread? 240. He owns it for 15 cents.
It's trading for like $2.
Yeah. So he then is in this call spread that he can't lose on, is what comes down to it. Or
very, very hard. And I have this now for the next until May 21st. Now I could buy another SPY call spread against it. I could do this multiple times, trade up and down against it, meaning if SPY goes down again, I'll buy a new SPY call spread. Or I can buy a VIX put, but what you do is you have basically choices what to do, or I could just close the trade now and reset a new one.
And bank the profits.
And just bank the profits and move on to the next thing. So the idea of having a two-way trade is by having a bearish part of the trade and a bullish part of the trade, and then concentrating on closing what is paying you, right? Because the whole part of this, what Mark was pointing out, is the market's up here today, and then tomorrow it's it's down back in the basement when there's a new headline.
Yeah,
so
I mean,
this is giving you the opportunity to do to basically have some confidence to put on a trade when the market is doing things that when the market is just churning up and down in a what I would call unpredictable fashion at this point. The only thing you can predict with any kind of certainty is that the SPY is going to move a lot. So you want a trade that's going to pay you when the SPY is moving a lot. If we free fall again, for whatever reason, it could be any news at this point, right? If we free fall again, then you know this is going to pay the bills. So it gives you confidence when you want to learn or try to trade this market. Now, two-way trading works in bear markets and bull markets, whatever kind of market you want, because basically I'm teaching you how to use volatility. You're learning how to use volatility to your advantage and reading what the market is giving you. And then you start looking at things a different way. Instead of looking at things solely from your opinion point of view, you're looking at things when the rubber band snaps back. How well does the position do, regardless of whatever your opinion is? So the important part of two-way trading is you have a bearish part and a bullish part. And when the market moves, you take the part that's paying, or you just close the whole position if you want for your money, and then you can reset a new trade. So that's basically, that is the gist of two-way trade. So this is an idea I just gave for students on Monday. So normally we have trades on Wednesday, but I wanted to give them something, right? Now, if they're putting this trade on, they now have this call spread as basically an anchor. If the market does anything crazy, now they own this call spread for, basically $1.40 or less, maybe even $1.25. It will maintain that value for at least 2 to 3 more weeks. Gives you a lot of opportunity to trade. So,
yeah, and Andrew, one of the problems that I'm sure everyone has here: how many people would like to buy the bottom of this sell-off, but are scared to put a foot out, or nervous? Maybe scared is a strong word, but are nervous to put a foot out.
Right, everybody.
Everybody.
Everybody. How do you go?
Everybody
all in
wants
at the bottom,
to buy
right?
the bottom, but also everybody's also afraid that the bottom is not the bottom, and you think you're at the floor, but there's a trap, but you're actually standing on a trap door.
Right.
Right. And what this strategy allows a trader such as yourself or anybody to do is to go long strategically. And if VIX does go to 100, if we do get the 2020 repeat, if the doomsdayers are correct, then you're going to be happy anyway. You're going to make money, so much money on that call spread, right? That call spread expands. It's worth $1,500 at expiration.
Right.
And if we take off, that call spread is going to make you a lot of money. And because you've got this VIX position, you can take money from the one call spread off the table, put on a new call spread, and ride it up, up, up until we turn around.
Right. So what it does is gives you some confidence, it gives you some choices, it gives you trades to close, regardless of really if the market's going up or down. And it also does it at a discounted value. There are a lot of little tricks in it that I teach you just from all the, it's just stuff I've learned over the years. And basically, I know we're running out of time because we're running to 10:30. So again, we're going to post a link of a research presentation. So if you're not a Weekly Profit Cycles member, I think you want to check this out. We're going to play it for you right after this presentation, where Mark and I walk you through two-way trades, and you understand how you can use it as a portfolio hedge, and basically how I was able to put on a call spread and make 270% on the call spread yesterday. So the presentation is going to run right after this class, and it basically will show you and teach you how to understand using two-way trades and the advantages that it's going to give you.
Yeah, we're getting some really good questions and some comments. Deg D says, with options, we're always running out of. Sometimes we run out of time. No system is perfect, but WPC is darn close. Yeah, what do you do about the time decay function of this? I think is Doug's question. Johnny says,
here's an excellent point on that, right?
Yeah.
So we use VIX to cut time decay down by 50 to 70%. And I'll give you an example. Here's the easiest example I can give you, right? Mark just said,
Andrew,
we have our VIX call spread. Here we go.
We're currently looking at like your pins notes or something.
All right. Like this
one.
Oh,
no, now we're good. Yeah, we're good.
Okay.
Now. Never mind.
So Mark just said, so if I buy, I'll give you a question. We have a 30-45 call spread and VIX is 37. is that call spread really decaying going into expiration? No, right? Because VIX is 37 and I'm long the 30s and short the 45s. As long as this continues, as
Your
long
options
as
will
this
not decay.
continues, your VIX call spread is actually going to decay in the opposite direction. So the whole idea is you're using what the market is giving you to reduce decay. So
Yes.
it's very, again, it's a system that's taken a little while to design. It will look, I think it looks easy. Apparently I'm told it's not easy, but I think it is easy to implement because you're going to sort of rinse and repeat every week a certain pattern of how you want to trade and how you want to approach the market.
Yeah.
Again, there will be a video that will be replaying in this room right after this class. So if you're a weekly Profit Cycles member, you already know what's going on. I wanted to give you the setup of a trade idea for this market, and take a look at that. You will definitely learn something. You will learn about some surprising patterns in the market and how they work, and and how it can make you a better trader. And I believe Christian's going to put that up.
Yeah, and we've got a sales letter, and if you'd like to join Andrew and Weekly Profit Cycles, we do have a very special special offer for you guys to try out. Normally, we don't have a monthly option or quarterly. Normally, it's just annual only.
Yep.
And we're offering really good savings on all of it. The monthly's just the monthly just to try it out, check the system out. But if you go with the annual, you save a chunk of cash. So, take a look at the options. And yes, we've got your opportunity to join Weekly Profit Cycles on the cheap today. A few more questions. Again, Johnny says, no system is perfect, but WPC is darn close. Andrew wants to know why do you do like a spread versus, let's say, like a strangle or a straight call?
You know what? It's cost. I want to keep the cost of the trades right around 650, like on average. So when volatility gets this high, we use more spreads because it's just a more expensive trade. It would be a lot harder for students to get into trades. Like, you buy a SPY call and a VIX call, and all of a sudden, you're into it for $1,400. So spreads are to bring the cost down into a more, what I would call, retail friendly area.
So if option prices are a lot lower, so let's say VIX is 13, you're probably just going to use a straight call and a straight put. What you're telling us
Correct.
Is at 38 or 37,
Yes.
Option prices are historically high. Yes. And in order to get the cost down, you spread, and that cuts the cost by more than 50%.
Right.
While still giving you plenty of upside.
Right. So, yeah, because your option premiums are 3 times the price. So what used to be a $2 option is $6 or $8. So the link is, we are going to be running that in the room. The link is right above.
Yeah, here you go.
And Mark is posting a link again.
In this, I've now pinned this to the top, so it's above the whole chat for you guys to find it. Upside and less theta. That's what Shane says. That's correct.
Basically the idea. Yes.
It's really a great system. Andrew, it was kind of an idea that Andrew and I started when we were at the fund, but then Andrew took it and gave it a twist that and really honed it in to become kind of a perfect strategy for just about any market. And that's why we call it Weekly Profit Cycles and not, because there's such a regularity to it, such a routine. It really does. When you have that routine, it makes it really simple and easy to trade. So yet again, it did get unpinned to the top.
Your thing unpinned from the top. There you go.
Up there, they've repinned it. I think they might have.
Thank you. It's been repinned. All right. So I know we got the rest of our day going on.
Oh, they've changed. Yeah, it's a different order form. So here's the order form that we wanted to use, and we definitely want you to join.
And we'll have a trade tomorrow. We'll have a trade, and it'll be tariff day, and we'll have a two-way trade for tomorrow, and we will be running it and seeing what happens.
Yes, absolutely, and we can't wait to have you guys join us. Any more questions for Andrew or myself? I think we've kind of laid out the plan here. We're literally at support right here, 5250. This is a key level. I'd really like to see us. I'll feel pretty strong that we're going to have kind of a little bit more follow up into Wednesday morning if we can stay above 5250. And I'll be back tomorrow at 10 a.m. to follow up with you guys. I've told you we will be here every morning at 10 a.m. Until things start to calm down and you guys feel safe. We here at Option Pit, our number one focus is making sure our traders and the traders in our atmosphere, even if you're not a paying client, are making as much money as possible and navigating this market as smoothly and efficiently and profitably as they can. And that's why we're here. So
you guys have a good day.
We hope everybody has a good day. If you have questions about weekly profit cycles, feel free to email my team, support@optionpit.com, or you can call us 888-872-3301. And I promise you, Ted and his incredible team of customer care reps will take very good care of you. But the easy decision, just click this link and join Andrew in Weekly Profit Cycles.
And the video will run here, Mark.
Yep. So I would like to just say thank you to everybody. We will see you tomorrow. And so for Andrew Giovinazzi, I'm Mark Sebastian. I am your only option. Have a great rest of your trading day.
It's an unnoticed pattern that happens in the market nearly every month, 96% of the time, and recognizing it created the biggest breakthrough of my 30-year trading career. It's like clockwork, 105 out of the last 110 months. Most people don't look for patterns like this, or if they do, they don't know what to do with them. But I'm a professional trader, always looking for an edge. So when I see a pattern like this, I know right away I have that edge. You see, a reliable recurring pattern like this can be exploited. And that's why we look for patterns. Any pattern this reliable can be used to gain an edge. And this particular pattern allows me to place a two-way trade each week where I don't care about market direction or the timing of my trade. The pattern isn't about going up or down. It's not about Fed meetings or earnings. It has nothing to do with AI or crypto. It's so concrete and predictable that the pattern represents stocks in 99% of all American portfolios. It's about a move, a percentage. It's about action in the market. That's all a good trader needs to find an edge. Today, I'm going to dive deep into that move and show you exactly how it works. You see, stocks can explode higher or crash lower, and I still make money. Movement is the key, and it doesn't have to be crazy moves either. The pattern executes 96% of the time. So don't think of that the move we're talking about has to do with a crash or a bull run. It doesn't. It's so bread and butter that it goes unnoticed to the normal trader or investor. But for pros, it's all we need to get that edge. It's so powerful in my hands that I'm here today to unveil it for you. My name's Andrew Giovinazzi, and I've taught thousands of traders, the same traders you see in the background of the CNBC or on the floors of the NYSE or CBOE. I've taught them live in the pits of Chicago, the floor of the P-Coast in San Francisco, and from my perch in Maine at Option Pit for the last 10 years. I know, it's hard to believe I've been teaching students how to trade for that long. I'm so young and good looking. Now I'm the proud head trainer at our boutique firm, Option Pit. And I want to tell you exactly how we found this pattern and the success we've had trading it. It's created a revolution, and hundreds of people are already taking advantage with two-way trades. So I'm here today with Mark Sebastian, the CEO and founder of Option Pit.
Hey, Andrew. I'm really excited about what we're going to talk about today.
Yeah, me too. All right. So Mark and I are both professional traders, and we used to work together on the floor of the CBOE. That's the Chicago Board Options Exchange. Before we left to form Option Pit, a boutique trading education firm that trains everyday people like yourself how to maximize their portfolios.
And when we say everyday people, we don't mean it as a dig. We're talking about everyone who isn't a professional trader, which is 99.9% of you. Because without traditional training and over 30 years of options expertise, you never could have spotted this pattern or known how to construct a trade that pays you.
Mark and I are here today because there's always an opportunity to make money in the market. But as pro traders, when we see a pattern that happens over 96% of the time, we create a profit plan, and we have. And that's what we're here to show you. Over the last year, we've been testing and testing and testing to find the perfect trade to pay us on this predictable pattern, and we've actually doubled our results.
You know, it's funny, Andrew. A lot of people think the market is random, and they're not wrong. The vast majority is random. But as you discovered, this pattern has occurred 105 out of the last 110 months. Think about that for a second. That's a wildly reliable pattern. And as we always say, anytime we see a predictable pattern, we can trade it and we can make it pay. And you were just telling me, Andrew, trading this pattern actually gets better and better as you trade it.
And that's one of the best parts. You see, when I first noticed this pattern and launched this strategy a few years ago, I was averaging an 8% win rate every 14 days. I wanted a consistent, repeatable, hassle-free trade that would generate weekly income. And I was happy with that 8% every 2 weeks.
That beats financial advisors. That beats most hedge funds. That's a solid weekly income strategy and one where you keep 100% of the profit. You're not paying someone a slice of the profits.
And fast forward to now, we're hitting a 20% return every 14 days on average. That's over 2 times our original returns. And that's not a hypothetical number. It's not cherry-picked or from a back test. 20% every 14 days across all real issued trade alerts. This number includes both our winners and losers. Here's our full track record, and we'll dive into this more later. One of the things you'll learn about us here at Option Pit is that we are fully transparent. We do not shy away from showing you our results. And we're actually trading these ideas alongside you. Today, Mark and I are going to show you how we win with two-way trades in up markets or down, how I pinpointed this holy grail predictable pattern, and how to target 20% every 14 days on average.
Plus, and I am super excited about this part, how we set up for rare 400 to 500% wins, or even more, while everyone else in the market is getting destroyed. Hedges in the market as insurance are critical to not only every trader, but every investor as well. Why just ride the train when you can drive it? This strategy has perfected an essential hedge. We call it a portfolio saver.
That's correct, Mark. And boy, it really could do just that. In the next 12 months, between weekly two-way trades and our portfolio saver hedge, I expect we will maintain a 70% win rate. And with 150,000 I have currently in play on this strategy, I'm looking to make 60,000 or more. I created this two-way trade strategy because the pattern was too reliable not to. But I also wanted to give traders like you a chance to make more money hassle-free. With this strategy, what we make, we keep 100%.
You don't have to have 6 figures to make these trades either. The average cost per trade is a little over $600, and we never have more than 4 trades on at one time. So the minimum you would need to trade all positions is only around $2,400. In 1 minute, we're going to take a look at our results. We've been talking about 20% every 14 days, and we're going to show you what that actually looked like depending on your position sizing.
Yeah, and when I built this, I knew I wanted a scalable strategy that was going to help the most people. Start off and learn as a one-lot trader and see how it works, or start off with a class and a paper trade if you want. Our goal here is for you to make the first trade with pure confidence. We hear our traders say, wow, I'm starting to get the hang of this. We design our trading for everyone. Remember, I was a trader and trainer for over 20 years, and that's why we've made this as simple as possible. So, if you're trading one contract, you've risked $2,480. You made $1,791. But 5 contracts, 8,955, 10 contracts, 17,900, and 20 contracts, 35,820. Now, I know when you see results like this, the sirens are going off, a 96% recurring pattern, 70% win rate. It all sounds too good to be true. It's easy to say there's just no way. Or even if you're doing this, there's no way I could. Or maybe even, oh, well, you're just out there selling options all the time and scalping trades or some other system that's just not for me. Let me tell you, this is not an option selling program. That works great until it doesn't. Because in a single trade, it could put all your gains at risk. Only rookies would be in the option selling game long term. Part of this program and having access to the expertise of pro traders like Mark and me is learning how to manage a book of trades. I've taught thousands of paying students since 1993. Even this guy, when I was back running programs for floor traders. I built my whole career on risk management. And let me tell you, the less you lose, the easier it is to make money.
All right, Andrew, I'm going to ask the question that I think everybody is thinking. Why aren't more people doing this?
It's funny you asked that, Mark, because believe it or not, I actually stumbled upon this pattern from trial and error. You see, when you're sitting on a floor trading millions of contracts a year, you learn the hard way. And once you have an understanding of what works, you can build trade programs that harness the market's energy and pay you. For example, the first person to discover a lump of coal probably had no idea what it was or that it was even valuable. But over time, and monetizing that commodity, they learned the true value of what they've discovered. So what may look like coal to you, to me is a diamond mine. It all started with a simple question. How much does the S&P 500 have to move for me to make money buying options? And I didn't know what the answer was. But I wanted to, and thank goodness I asked, because what I found became our predictable pattern and the source of our two-way trade. I found I only needed the S&P 500 to move 2% every month to make money trading options. I want to repeat that. And when we talked about that simple trading pattern at 96%, this is it. I was blown away by that, to be quite honest. And I would have thought it needed to be much higher. The fact that that move was that small scared me. I thought, wow, I won't be able to make a lot of money from that. And I bet it doesn't happen that often anyway. Boy, was I wrong.
Andrew, you know how much I like it when you're wrong. And boy, were you wrong. And we've been raking it in since then. Let me put that into perspective. To make money in a single month, the S&P 500 needs to move 2%. It's around 100 points. Could be up, could be down, doesn't matter. As long as it moves. That's the movement you were talking about earlier. We make money.
And out of the last 110 months, the S&P has moved at least that 2% minimum we need 105 times. That's only 5 months in the last 9 years this hasn't happened. And once we have a certainty, and really this is about as close as you can get to a market certainty, then I ask myself, okay, what's the best trade I can put on to pay me on this 2% monthly move? And I created the two-way trades.
Yeah, let's dive in on these two-way trades. Why don't you tell me about what you do and how you created them?
So first off, two-way trades are a combination of VIX and SPY. We'll call them two trading opposites. And it's very easy from this chart to see that. But really, the fastest way for you to understand a two-way trade is to go through some examples. And let me show you a few we actually traded. So let's take a look. So the first example is we enter on October 25th. We spend $521 on the SPY and $175 on the VIX. Now, also, all we need is our 2% move during that time. Okay, and we're pretty sure, 96% sure, that that's going to happen. So we got our SPY move. We have our opposite move in the VIX. We close both sides of the trade, and we get a 17% profit in 5 days. Okay, so example 2. On September 27th, we spent $325 on the SPY and $420 on the VIX for a total of $745. Again, note that we have a 2% move, which we expect about 96% of the time. We get to close our SPY, then we close our VIX, which is the opposite trade, for 19% profit in 2 days. We are in, we are out, and we're done. Here's another example. We're running the trade from January 24th to February 7th. We bought SPY put verticals and VIX puts and one call vertical in SPY. The total we paid for the trade was $465, and we were out of the trade with a 16% profit in 15 days. Now, how do we do that? The first thing is the chart of the VIX where we wanted to capture money on our puts. So we entered the trade right here around the 24th. We had a run up in price, and then VIX collapsed into the end of the trade where we closed the puts. So that's, again, closing one part of the trade, leaving the other part of the trade open. The second part, running when we owned SPY calls. So we had an upside where we got to sell the calls relatively early in the trade. And then on the downside, we had a quick, sharp move in SPY, and we were able to get out of our SPY put spreads. So the way the trade worked was we were able to hold the VIX puts for a longer period of time, and we closed the SPY in a very short period of time.
Andrew, this is about as reliable as a geyser in Yellowstone. Another key piece to that reliability, though, is how you close the trades. Can you walk us through your closing rules?
Yeah. So here are some of our rules for closing these trades. When we put the trades on, we put both sides at once, and we do that immediately. So one side is winning. I'm not trying to pick a bottom, and I'm not trying to pick a top. And I don't care about the specific moment that I put the trade on. I always put them on at the same time. That's key. Number 2, I don't even look at the trades until one side is up at least 50% from where I put it on. Number 3, I ride that 50% till I hit an 80% gain. That's my target. And when I set that, I look to take it off. Number 4, anytime I have a momentum change. So once that one side is off and I have a change in momentum, that's when we really clean up and make some money.
So you're making enough money to pay for the one side of the trade with the other. And if momentum shifts and the other side wins as well, that's what takes these two-way trades from consistent 20% every 14 days and makes them home runs, correct?
That's correct, Mark. And let's look at another example. So, again, knowing what we know now, on August 30th, I spent $285 on the SPY, and I spent $360 on the VIX, for a total of $645. Again, we had a much bigger move in SPY this time. We get our 2%, which we expect around 96% of the time in a month. I take profits on my SPY. I take profits on my VIX, which is the opposite trade. We close for $795, or a 23% profit in 7 days. Okay, now here's another example. So remember, we're putting trades on. We don't necessarily have to be right on direction. We just need to let the market move one way or the other. So this was a one-day trade. It happened very, very fast, from February 12th to February 13th. Now what happened here was we got a very, very, very sharp spike in VIX, where we were able to take off that position very, very fast. On the SPY portion of the trade, because we had the very quick drop from the 12th, we got to sell our puts very fast. And then by the end of the next day, we were able to sell our SPY calls out. So we had a very quick turnaround in SPY in 1 day, because the market literally had a 2% move in 1 day instead of 30 days. And then we just exited our VIX put at our leisure. Now here's one more example from February 12th to February 15th. So we enter the trade on February 12th. Again, we're moving up very sharply in VIX. Doesn't matter, even though we own a VIX put, it doesn't matter to us. We don't have to close our VIX put. What it did give us the opportunity, though, to do is, because the move was so sharp up and down, we were able to run our SPY calls for 3 days. We had a sharp 2.5% move up, and I was able to sell my SPY calls easily, and then go back and hold my VIX puts for a nice close after VIX collapsed from this very sharp peak. So once again, we don't have to be worried about direction. We're just really looking for the trade to close that's paying as fast as possible. Now here's one more example on about a 5-day hold. So from March 6th to March 11th, I have a VIX call and a SPY call spread. Now you can see we have basically a straight up march for VIX. And I ended up selling the call somewhat near the peak. On the flip side, I was able to exit my SPY call spread early because VIX and SPY were actually running together in this particular case. SPY going up 3 days of straight run up. I was able to sell my SPY call out, and I was able to sell my VIX call out and make a 30% profit in 5 days. In this case, I made better returns because I was able to close both my SPY call spread profitably and my VIX call profitably. And those are my examples of how to trade weekly profit cycles. Now, I'm going to do something here that people don't normally do. I'm going to talk about a trade that didn't work. Now, in the last year, out of 30 trades, we've had 26 winners and 4 losers, and our biggest loss was 35%. Now, on this trade, we made a critical mistake. We didn't close a win, and when the market reversed, our gain quickly evaporated. And what I learned from this was that we need to take our profits sooner. I got a little greedy on this one. But as I was saying earlier, this strategy is always evolving and I'm always learning. I'm always making adjustments. I'm always optimizing two-way trades, making them stronger and easier. Adjustments like this are what catapulted our results from 8% every 2 weeks to 20.
We've mentioned this a few times, but I know we're going to get questions about the portfolio saver, the massive hedge that's literally built into the strategy. Talk to us about how that portfolio saver works.
Okay, as we know, people are always waiting for the other shoe to drop. And as a matter of fact, according to most market research, there's a bear market fear in all of us, myself included.
Yeah, me too.
So when the market becomes hot, I'm always waiting for the downside. So I built in downside insurance with the portfolio saver. Here's how it works. As long as you have a two-way trade on, if the market falls through the floor, you're going to get a serious windfall. This won't impact our two-way trade targets, but like all smart men, I want insurance, and this is it.
Let me step in real quick and talk about one of the most exciting aspects of two-way trades that I use myself, the portfolio saver. You automatically get this insurance. It's literally built into the two-way trade, meaning that if the market has a huge move to the upside or the downside, that's great for two-way trades. We're going to see way more than our 20% target. Right now, you have what, $150,000 in the strategy? Say the market was limit down. That means the market drops 5%. When the market drops 5%, they actually stop trading for a half an hour. So if that happened, they pause trading. Everybody's terrified. How would the two-way trade perform?
So instead of 20%, I could make 3 to 4 times my money on the trades I have open. So I'm doing the happy dance, I guess.
Yes, and everybody wants to see you do your happy dance. Let's face it. So to sum it up, there's a market pattern that happens nearly every month. 96% of the time, we've shown you how to harness the VIX and SPY to build two-way trades. We showed you our track record, and we showed you the invaluable insurance of the portfolio saver, which in a single trade can return 3 to 4 times your money. How can everyone here learn to do this?
I've developed two-way trades into a trading program that you can join today. It's called Weekly Profit Cycles. Weekly Profit Cycles is where we take advantage of the 2% monthly move. It's where I'm alerting these SPY and VIX trades, and it's where you can actually put on the positions with me. Let's walk through everything you get when you join Weekly Profit Cycles today. First, you get the Trade Strategy Dossier, which explains all of the trade varieties that we have and the conditions that make Weekly Profit Cycles work. And counting down to the next live session on Wednesday, every Wednesday at the same time, we have a trade. If for any reason we are not going to put a trade on Wednesday, we will put out a RIF trade that's off cycle for that week. Now, next you get 2 live trading sessions per week. You get a session on trading and a session on education that are about 45 minutes long each. There are people using this strategy and live trading with me on Wednesdays who had never used two-way trades before this, who are now entering these trades each week on their own. These two-way trade masters will also be at the Wednesday sessions.
Yeah, and I want to talk about that. You literally did take a bunch of people and show them how to use two-way trades. I want to talk about my friend Cleet. Cleet's a member of Weekly Profit Cycles. He dropped every other trading strategy that he was running and is now primarily using Weekly Profit Cycles. In the last year, he told me he's made almost $60,000 trading the Weekly Profit Cycles strategy, two-way trades.
That's pretty fantastic.
It is.
When you join, you get two-way income trade alerts, either email, notification from our app, or on the website, all in real time. Next, you get our 1-hour getting started class, so you can hit the ground running, getting ready to trade your first Weekly Profit Cycles trade, your very first session. And lastly, you're going to learn to create your own small hedge fund using the Weekly Profit Cycle system. And this is what I'm most excited about, giving people the opportunity to learn how to trade the market in any condition. We truly built this to be as simple and hands-off as humanly possible.
So, when's the next trade?
Wednesday. This coming Wednesday, we'll have our next Weekly Profit Cycle trade. And as we said, we'll put it on together in class. The goal, as always, is 20% in 14 days, or even better, of course. I want you to join me before our next alert. And today I'm offering you a special price for new members of Weekly Profit Cycles. In fact, I want to make it as easy as possible for you to join me. OptionPit stands behind all of its products, and it's our policy to offer a 14-day money-back guarantee. If you aren't satisfied with the service, we will refund your money, no questions asked. That way you can attend 2 live sessions and put on 2 trades and really see the value of this strategy for you for 14 days. Click the offer on your screen right now and make sure you get in. And when you join, I'm immediately going to send the trade strategy dossier and a few other bonuses you'll see on that order page. So make sure you click right now and check them out. We'll get you ready to trade and up to speed before our first live session. And make sure you're fully equipped and confident to place your first trade with us. I can't wait to have you as a new member of Weekly Profit Cycles. And Mark, thanks for joining me here today.
You bet, Andrew. It's been a pleasure as always. I am so excited to see what's next for Weekly Profit Cycles and to welcome all of today's new members.
Make sure you click that link. And thanks for joining us. I'm Andrew Giovinazzi, and I'll see all of you in your first live session on Wednesday.